Tom Lee, strategist over at JPMorgan Chase, says the bottom line is they remain constructive on equities for now. He joins us live from New York. So, Tom, you know, last week, it seems like folks were getting negative. Very positive tone today. What do you think of the trade that we're seeing over the last week or two?
Well, I think we're showing that investors are getting impatient, that they're tired of uneven data and something that's not going to convince them, you know, one way or another that we're in a sustained recovery. As our sort of teams call through everything, we think the most important convincing data point to come is going to really be on payrolls. And you know, when I talk to investors, I think if we get deposit payrolls before year end, not only is that going to be a surprise, I think it's going to convince a lot of investors that this is a sustained recovery.
I wonder, do you look at all the news we had today as clearly positive? Because the market's interpreting it that way, but you still have 512,000 people filing for first-time unemployment claims. And if you look at the productivity number in a different light, you could see that more people are getting fired. Those that stay there are getting paid less. And with that, they can do less out in the retail economy.
Well, that's true, and I think that because you can kind of look at both sides of each number, you do need to have tie-breaking data, something that's going to clearly put us in the camp of recovery or not. But on the claims number, you know, that's always kind of a gross number. You know, that's the number of firings, and we don't really know the gross hirings number. And that gross hirings, if we ever knew it, would really help us calibrate the payrolls number for the month. And on the productivity, you know, I think the Morgan Stanley analyst made a very good point. You know, companies can't sustain productivity growth or high levels of output without starting to hire. And I think actually that's why we think when you start to think a few months ahead, this is all positive for payrolls growth.
So what's your take on tomorrow's number? I mean, what are you looking for to put us clearly in the recovery camp?
Well, I think a number that improves over last month is going to be a movement in the right direction. But we would need to have something meaningfully positive. Our economists are looking for private payrolls to shrink by 140,000. So that, if we hit that number, that's a nice surprise. Consensus is for a loss to 175. But again, the details will be important. You know, manufacturing, the employment survey in the manufacturing ISM really suggests we could see some expansion this month. But then, of course, we looked at the services number, and that kind of relapsed. So the details will be just as important.
You know, I also found interesting, Tom, in your research is you point out how the S&P 500 has typically risen about 12% in the 4 months prior to payrolls turning positive. So to me, that says there's still certainly more room to run when it comes to the equity trade.
That's right. And, you know, and actually in that piece that we had put out, we had pointed out that when you looked at the deeper recessions, you know, where employment went to higher levels, the market's rally into a positive payrolls number was sharper because by that point in the recession, payrolls became a very critical issue for investors. And I think we're at the same crossroads today. You know, investors just don't like the fact that we're possibly going to break 10% unemployment now. But if we see a path for that employment to start turning into positive payrolls, investors are going to get very excited.
Tom, let me ask you, though, about the psychological impact of a 10% unemployment rate. Many guests have come on and say when you see that 10%, that's going to freak out a lot of investors. Do you think there'll be a big psychological component to it if we get that 10% number?
Well, you know, I'm sure when we get to the 10% number, there's going to be a lot of people prognosticating that we're going to be in for an era of permanent high unemployment. Very similar to the type of forecast that came out in '82 when you got near double-digit unemployment. The key is really going to be how quickly the economy really begins to expand. So we go through a period of inventory liquidations. I think we've now sort of finally bottomed. You know, it's apparent from hearing all the companies on the earnings calls. But we do need to have sort of the pillars or the engines to start expanding again. So the 10% maybe not as important, but the fact is we are sitting with a lot of capacity in the economy.
Hey, you know, Tom, back in '81, '82, when you and I were still riding big wheels around the block, we went to 10.8%, and it was a year after the recession had ended before it turned around. How far away do you think we are from that?
Well, you know, in the 80s and the 70s, the unemployment rate actually was increasing because of the number of people entering the labor force. You had back then, I think, almost 4 million per year entering the labor force. Today, it's around 2.5 million. So we're probably going to have a lot less pressure on the economy in terms of having to create jobs to prevent the unemployment rate from rising. Today, we need to have around 250,000 jobs a month, though, to keep the unemployment rate flat. So it's possible that the unemployment rate will rise for a while. But I mean, if you and I start to see a 250,000 a month positive jobs print,
right,
we're going to feel very good about that.
All right, we got to run. Hey, Tom, thank you so much. Tom Lee of JPMorgan.